Good afternoon from the Shreveport office of Eagle Financial Management Services for the latest edition of the Jack and Bill Show. Now, Bill and I took a quick due diligence trip to Scottsdale, Arizona to visit with, you could call them a hedge fund or an alternative fund. Had a great trip. It was brutal, though. 3 of our 4 flights were delayed. The Phoenix and Dallas airports were slammed, and it was just an overnight trip so that we could get back here in the office and get everything done at the beginning of the quarter in this shortened work week. So Bill came a little bit under the weather from the difficult excursion. So we have our friend Steve Umberger with us again. Steve happens to be 20 years older than I am. We're both, I shouldn't say this, we're both barely over 60. We both turned 60 in April. And Steve is the CEO of Bayou Boys, a meat pie or empanada company. And they were in town after a trip. So he bebops in here about a half hour ago, and I stuck him in the chair. So we're going to have some fun today. And just to give a quick market recap, Steve is a very experienced investor. By the way, he's owned 2 professional football franchises and started, I think, 5 privately held companies all the way to IPO. The most recent DoubleClick, which is a subsidiary of New York Stock Exchange, ADS.
Yeah, Value Click.
Value Click. I'm sorry.
Value Click. Yeah.
And but anyway, so this week it's been kind of crazy, Steve. The S&P 500. If you look at the last week's stock market, when I sat down to do this last week, the S&P 500 was up 15.9% year to date. And then Friday was an up day. Historically speaking, Mondays and Wednesdays, there's some correlation that those are up days and Fridays down days with people selling at the end of the week. Not something that I would ever try to bank on. But so today, as we get ready to do this, the S&P 500 is up 15.9% year to date through yesterday and has another large, big, roaring, 1.1% or 48 points on the S&P. That was about 5 minutes prior to the close. So we're now up about 17% year to date on a total return basis for the S&P 500. And Dow up 1.33% today. Those are records for the S&P and the NASDAQ. I think also for the Dow, all-time highs. Dow up 465 points today. NASDAQ Composite up 0.9%. The Russell 2000 smaller cap index was up 2.1% today. Just really a blowout day. Safe havens. People sold treasuries today to get in on this stock market advancement. 2-year treasury note yield has climbed with concerns that the Fed is going to have to tighten sooner rather than later. So we've seen the 2-year note yield go from 15 basis points to 25 and back down to about 23. But treasury yields were off today as people sold treasuries to buy stocks. The 10-year at 1.35 and the 30-year, which had been as high as about 2.5, just flirting right around that 2% level today. Silver 26.25, up 26 cents an ounce, or call it 1%. Gold closing at 18.15, up $8 an ounce. And I think the Fed's Mary Daly, the San Francisco governor today, Steve, was saying that this Delta variant, which really shocked the markets kind of yesterday. What I mean by shocking, I mean we had a doubling of the number of deaths in Singapore overnight. The Gulf South area where we live, people who eat empanadas or meat pies aren't really in a hurry to get vaccinated. So this Delta variant has been rampant through Alabama, Mississippi, Louisiana. And anyway, Mary Daly said that this could be our central banker's excuse to delay rate hikes. And the market takes off on that news today. And again, with Pfizer and BioNTech, that combination, they developed, their messenger RNA vaccination that to date has shown like 95%, 96% efficacy. They now come out, I don't know if you saw this or not, saying that they're submitting an indication to the FDA for the need for a third shot. So, anyway, that's, this virus has mutated. There's a lot of back and forth about, I really wouldn't have thought when this first came out that we'd still be dealing with this, still having to wear a mask in the airports and on the aircraft, the whole time, during our due diligence trip. Well, anyway, we've got a special treat for you. I'm going to turn it over. Steve is a serious investor, and he's in town. So I just thought, man, let's throw some questions back and forth and get some dialogue going that might be relevant for today's viewers and investors in general.
I'd love to just kind of have a good conversation with you. I have some questions, and you and I talk frequently. And Jack, let me ask you. There's so many data points on. One minute you think there's going to be inflation, next minute there's deflation. The bond yields are down. Next minute we're running up big debts, and we're here talking about inflation. How are you all playing that? Or you just kind of march to your own, plan and just kind of see how it goes? But where do you see this inflation deflation argument ending?
You didn't tell me you were going to ask me that. That's good. You don't have to tell me anything. I like to keep it loose and off the cuff. Okay, that's a very good question. Historically, Steve, 2/3 of all inflation comes from unit labor cost increases. And most businesses in the service arena, and manufacturing are finding that they're in competition with the government right now. So workers are not coming back to work because they're being paid to stay home. Now that is, there's this one word that we keep hearing all the time, transitory. That's the $64,000 question. Is this inflation transitory? Because if you look at we go by the CPI, Consumer Price Index, and inflation just means a general rise in prices. Deflation would be the opposite, or a general decline in prices. So we've had inflation in the last year measured by the CPI of or year to date up about 4% because we've seen energy prices go up off the charts, and natural gas, oil. The Dow Jones Commodity Index is up about 25% year to date. I think that some of those things, we've seen lumber prices double or triple. Some of that I think is transitory as we see workers come back to the workplace. But I think we could be in a commodity super cycle, and I think a lot of it has to do mostly with the demographics of the developed world. We have an aging population, and there's a labor shortage going on right now. And that's why we could see inflation that's here to stay for a while. So what have we done about that? Our clients, we've had some huge winners in energy this year. We've been overweight natural resources, or things that are real, things that will appreciate if you do have inflation. But we've had monetary inflation too, Steve. When the Fed pushes interest rates down to nothing and utilizes quantitative easing, you're going to have financial assets appreciate or inflate as well.
Right.
So,
okay. So here's a question. I had a small business that I know that's doing very well, and they had, they're putting some money aside for taxes. They have some cash, but they don't want to invest it because there's a risk to it. You know,
Right.
and so where does a small business or individual go that doesn't want to take on risk to get some yield, if at all? It seems like
Right.
it's almost zero yield out there for cash.
Right. I think, and the biggest part of that question, you know, we actually do cash management for businesses, corporations, and individuals for money that is meant to be utilized for operations. You know, that money has to be there, obviously, to write checks and things like that. But, you know, what we're doing, of course, we just set the 2-year treasury, which is that's our government guarantee, that yields 0.23% right now. And so less any kind of fees, you know, you're not really getting anything. You might be able to get a little bit more on CDs, but certificates of deposit are not the most liquid investments out there. So, you know, what we have found is if you can stomach just a little bit more for the cash management that we're doing, we've been utilizing very short-term exchange traded funds that are very short-term, most of them holding, adjustable rate notes, adjustable rate bonds of recognizable corporations like Morgan Stanley, Goldman Sachs, firms like that, or even adjustable rate munis. You know, we own, I think, a Massachusetts general obligation bond that we own, and the U.S. Treasury is a GO as well. That's backed by the full faith credit and taxing power of the issuer. So we own some of those that are adjustable rate, and the Massachusetts GO that we own is actually further backed by what's called a monoline insurance company, BHAC, Berkshire Hathaway Assurance Corp, which we view as the strongest one, you know, out there. So we also own some short dated, what are termed baby bonds. And my colleague Bill and I have discovered that since the pandemic, the credit markets took a huge hit back in April and May. And there's still maybe a little bit of room to go there, but the door is slamming shut quickly with these baby bonds. These are small issuances of, say, $30 to $100 million. So, you know, a PIMCO income fund can't buy these because they're not meaningful. But we're able to go in there, and I put in a bunch of orders in the morning and see what fills in the afternoon. And they're a little bit less liquid, but, you know, so we'll combine that with liquidity along with some CDs, and depending upon the risk tolerance of the entity, of course, you could use short-term margin if you had to. You know, margin rates are very low. That's a tax deductible expense, but just depends on the yeah. So there's some ideas.
Let me take you down this path for a moment. Alternatives. I think that if you ask 50 investors, they would have different definitions. You know, we think of stocks, bonds, cash in buckets typically, and then alternatives started creeping into the conversation. What do you define as alternatives, and why are they important?
You know, we have investors that have gone from 50% stocks and bonds to 50% stocks and alternatives. So if you start with a mix of stocks, if you think of being long, or that means owning it, short is borrowing or the opposite of a long. But if you're long, or you own stocks and bonds and cash, okay. Now think of anything that doesn't fit in that category. Okay. The definition.
Give us some examples of something that doesn't fit into that category. It's private equity.
Absolutely. Private equity. There are alternative investments, and there are alternative strategies. There are a lot of, like, some of the things that we like now are like BDCs, business development companies. Our firm has had a lot of success. You have to be very careful with these, because now a BDC, These filled the void left after the subprime crisis in 2009. The Obama administration made it prohibitively difficult for commercial banks to make adjustable rate loans to mid-market America. So there are these entities that came about like Apollo and Blackstone and BlackRock, and they do a lot of this with adjustable rate loans, working alongside private equity, and some of them get highly levered. They'll issue debt, so you have the debt of these BDCs. Some of these we actually like. The BDCs that we like are not highly levered, and they're the highest quality in the category. But that's an idea of what we would call an alternative. I think the first alternatives, when the definition first started, it was like real estate investment trust or energy investments. And then those got so commonplace that, or you could say timber investments or things like that, or you could say precious metals. Now, because of Nobel Prize winning theory, or what we would call optimization theory, doctors Harry Markowitz and William Sharp won the Nobel Prize in economics in 1958 for the economics work that they did, looking at covariances of different asset classes and combining them and reducing the risk of a portfolio by making it more efficient. It's interesting. I'll step aside here for a second. There's a gentleman that recently passed away named David Swenson. I've talked to you about him, pioneering portfolio management. This guy ran the chief investment officer at Yale University. I think it's the second largest endowment of every college and university in America. And I think he had 2% of their money in the S&P 500 and over 90% in alternatives. Now, so these are things that are illiquid. You can do illiquid things in commercial real estate. I mentioned BDCs. One of the biggest out there that we really like right now is, there's another whole universe outside of people that think of S&P 500 indexing and things like that. They're called CTAs, or commodity trading advisory firms. And so they have these algorithm run strategies that are time tested. And there are some of these that we really like, especially with, especially with the low yields that you mentioned in fixed income. A lot of alternatives have come in, and in people's portfolios, someone that has risk tolerance really doesn't want to allocate to muni bonds, an asset class that may have been very appealing 10 years ago that just doesn't yield anything anymore and has great risk if interest rates rise. So there are going to be winners and losers in this space, though. I've seen when all these CTAs came out with these algorithm run strategies, pardon my French, but 2/3 of them are crap. High fees, poor performance, inexperienced management. But you have to sift through all this to find the things that. So there's a few ideas for you.
Okay. All right. Let's talk about international exposure. Oftentimes, I personally think that U.S. companies, typically a Microsoft or Google or something, do 70% of their revenue internationally, outside the United States. So is it good to go and buy a non-U.S. company to get your international exposure and deal with currency risk and political risk? Or is it better to say, I want to get international exposure by buying companies in the U.S. that do strong revenue and earnings outside the U.S.? What's the best way to invest in international?
Yeah, I think, if you were to ask, I think that most people that work in our business, Steve, now would argue that you need to go outside of the Microsofts and Apples and thinking of investing internationally that way. I think it's wonderful for the riskiness of these individual corporations that they have international business that, can really help them and make them, thrive. But, just like, you're a fan of indexing. But if you think of the S&P 500, you can do the same thing with the EFA index, which stands for Europe, Australia, and the Far East. Those markets sell at significant discounts to the United States market right now in terms of accounting-based metrics like PE ratios, book value, free cash flow to enterprise value, things like that. So I think that you're good if you own the S&P 500, you're going to have international investing through what the Microsofts and the Apples and the Amazons are doing, internally. But I think going back.
But you're saying all great ideas don't come from this country. You can
Absolutely.
find a way to get kind of juice up your return if you venture out a little bit internationally.
But you've got to be careful. Like, you need to know, I think emerging markets. Let's talk about one of the biggest risks here is currency risk. If you've looked at, because this was one of the things that came out in this Markowitz-Sharpe theory and optimization, that one of the most efficient areas to invest is emerging markets, because these countries are not correlated to what the U.S. markets are doing. However, they've discovered that over time that a lot of these smaller markets, like let's say South Africa, for example, that over a long period of time, when you convert your rands back into dollars, you've gone nowhere because of the currency risk. Or imagine, owning bolivars in Venezuela. I mean, who would want to have Venezuelan exposure? Who would want to have Chinese exposure right now? That's a little bit troublesome, to me. So I think you have to be careful with now. The most important way to do this is through developed markets. The developed markets are going to be predominantly Western Europe, Japan, and Canada. Maybe some places in Asia like Singapore. But it's interesting. The group that we went to see in Scottsdale, they have a strategy that utilizes exchange traded funds in the MSCI World Index, which I think is, off the top of my head, I think that's 62% domestic and 38% international. And so, So
you mentioned currency. Let's talk about that for a second. I often think of buying a share of stock as owning part of a business. That's the best way for me to rationalize what is this that I'm
absolutely
buying. And so if you look at currency, there's no business underlying that asset. So currency is a inanimate object, and the only way you really get appreciation is if someone pays you more in the future than you bought it at the price you bought it at. So how do you view currency as an investment?
It's interesting. I'll give you an idea, and I bet this is one that you haven't given much thought to. But like some of these, well, first off, there's some really smart people that do triangular currency arbitrage. So what the definition of arbitrage is simultaneously buying and selling a like security and guaranteeing a profit. So there are, we actually engage in that in some ways, not perfect arbitrage, but anyway, a lot of these CTA funds, or these algorithm run, these algorithms utilize a phenomenon known as trend following. And typically 25% of what these funds do is engaged in currency trading. So that's what they do. Is this is crazy counterintuitive, but let's say that you run an algorithm that's 6 months in time. That would be called short to medium term trend following, and they're doing this. Let's just say that they look at first off, when you're looking at a currency, you have to compare it to another currency. Like if we're comparing international currencies to dollars, let's just say that you're running an algorithm in currency trading that's a 6-month algorithm. Okay, over in any 6-month period of time, anytime a currency, let's say the euro or the yen, makes a new low or a new high against the dollar, you put that trade on. Okay.
Yep.
And then you use a very disciplined stop loss system, and maybe 10%, or there's some accounting based metrics that you can use a moving average system. But what we found,
are you investing in currency for your clients often?
We're actually doing that right now through some of these commodity based, CTAs. And we have 2 of these that have done exceptionally well this year. So there's a gentleman, I just read his book, named Tom Basso, who, he'll say historically with his trading, there's 1 or 2 trades annually that made most of his money. You get stopped out of, or you just have small gains or small losses. And a lot of these, this is very unique, or even in opposition to an index way of thinking. It's not buy and hold. It's lots of trading. So, yeah. So I think there's really a place for that, especially in volatile markets. And it's very, these markets are not, these are rules-based systems that try to go beyond human thinking, because it's very, I think of trying to invest thinking macroeconomically is way harder to do than one thinks. Wouldn't you agree, Steve? Trying to predict what something. Yeah,
absolutely. Yeah. I think I don't make macro calls.
Yeah.
If I knew what's going to happen tomorrow, then we'd all be rich, right?
Yeah, exactly.
If you really knew. So what are your thoughts on leverage, buying on margin, as a general, for an individual and for firms like yourself?
Generally, I mean, our mandate at Eagle Financial, really, Steve, is consistent with whoever the client is, whatever their objectives are. We target reasonable returns without undue risk. And when you start introducing leverage and more leverage to a situation, and I think of it in today's environment, the kind of leverage that we're seeing in the markets right now have historically been indicative of a market top. If you think like the Robin Hooders out there that are using a lot of leverage, sooner or later, if you're using a lot of leverage, you're going to get stung in a really bad way. That's what I think. Now
I agree.
Yeah,
it's hard enough to win once, much less twice.
Now, but let's just say that you need to you just got your income taxes done late, and you've got $150,000 income tax liability and $1 million portfolio, and you don't want to sell securities where you have short or long-term capital gains that you will realize. So you could borrow money. You could borrow money for 2%, 1% or less, depending upon the amount. Use it temporarily to pay your tax bill, and then pay it back in time on a short-term basis. There are reasons where margin can really make sense, and tax advantages. But I think of short-term, really, I am not a fan of using margin to speculate, generally speaking.
Yeah, well, it takes a lot of expertise. You've got a good team here, and you got Bill and you and the folks, but it's hard for the individual to be an expert in cash instruments. What's the best return on cash, and then stock, and then bonds, and alternatives, and then margin. So eventually, you have to almost do it for a living. One thing that's always bothered me as an individual investor is whenever I try to sell a preferred stock or a bond, I can't get I have to call someone, and it's behind a curtain on the cost. What can I sell it for? You say, I want to sell 1,000 shares of this, and they'll call you back, but you can't see it on the screen. It's behind a curtain. And to me, bonds are a mystery. It's very hard for me to sell them, understand them.
Yeah, I think over 90% of the bonds that are sold are done on a principal basis, and you better be working with someone that you know and understand and trust, really, because there are, I don't know what the rules now, but the MSRB rules, for example, in muni bonds, MSRB came out with a lot of people in the old days called munis like the last license to steal, because they could put a 5% commission
Right.
into a bond trade. Or I mean, here's why I'm going to make an advertisement for Eagle Financial. We are not like Merrill Lynch or Raymond James. We are legally carrying fiduciaries, and it's illegal for us to earn commissions. So typically what a lot of brokers do is they want to put you in long dated fixed income because they can bury a huge credit in there, and it doesn't change the yield very much the more longer dated they make it. Right. So that's just mathematics. And that stuff is easy to sniff out if you're experienced. So
yeah, well, it's hard for me. So okay. Last question I have is, in terms of what you do at Eagle Financial, you talked about alternatives, you talked about stocks and bonds. In terms of puts and calls and all that, how important is that to options in the business that you run?
Right now we have some clients that for the most part we utilize option strategies as a risk reduction. Like if you own, for example, Steve, if you own 1,000 shares of ExxonMobil, which is going to cross today at around $61 a share, and it pays a very nice dividend yield of, I don't know, it's 5 or 6% or something like that. But you could take advantage of the near-term volatility in energy prices, and you could go out to, say, September the 17th. Options expire on the third Friday of every month. Of course, we have weekly options now too, but September 17th is an expiration. And let's just say that you wanted to, you want to generate more income with your portfolio. You could sell calls on your Exxon. So one contract represents 100 shares. You could sell 10 calls. Let's just say we sell the September 17, 2021, 65 ExxonMobil calls, and we get $1 a share for that. So you put $1,000 into your account. That's about a 2% return on your money. You get like that, and as long as the share price doesn't go beyond 65 by expiration, you get to keep that money and derive some income from it. And if the stock declines, that option premium dampens the volatility. Now, you could be on the other side of that trade, betting that Exxon is going to take off from here. I think the easy money's been made there. That would be called a speculation. We don't do that. 9 out of 10 option contracts expire worthless. So, but we'll do some things like we put some call spreads on with Moderna and BioNTech, Pfizer, and made a bunch of money with those, and even Ford made huge. I mean, a year ago Ford was at like $4, and it's 14 and change right now. So if you have a really high degree of confidence with something that's thematic, options are a great way to get leverage to that. But you do it maybe with your winnings or some interest or dividends that come in from your stock or your index fund or a bond. And we're not a firm that but you mentioned this, the combination of alternatives and bonds and equities. We think now's the time in this market is the time to be very diversified, Steve. Yeah. And know why you own what you own. Yeah.
Yeah. It's a little concerning when you see PE averages, 30 years ago at 13 to 16, 17.
Yeah.
And then they went up to 15 to 19. And now whatever they are, they're so high. So and then you're asked the question, what else can you do?
Yeah, part of that. Now, a lot of the I've heard these fund managers say this, that, any asset is worth the expected future cash flows discounted back to the present at the weighted average cost of capital, cost of retained earnings, cost of common stock, preferred stock, and things like that. You know this all too well. Steve has an MBA from William and Mary in Virginia, and you learn all that stuff backwards and forwards and how to evaluate something. But my point is that when interest rates go way down, that means that the asset, you're discounting it back to the present at a lower interest rate factor. So the value of that thing, or think of an electric utility that they're large users of capital and their cost structure comes down with interest rates. So that makes the company, worth more. So part of it is interest rates, but what happens when interest rates go back up? It works against you too. And then the other thing is interest rates are artificially low by world central banks. So I think that the value, they've made the stock market the only game in town.
Right.
And it will be until it isn't.
Correct. And we don't know when that is.
Correct.
All right. Well, that's all I have. So.
Oh, that's good, man. Okay. Well, I hope that you've enjoyed our talk today with Steve. Those are some outstanding questions. There's, relevancy there to every one of those questions, we feel. I thank you so much for filling in for our man, Bill, sitting behind us. Man, you're going to have to come back in town and do this again with us. So, just want to say, hope everyone has a terrific weekend. Be safe, and we'll be back next Friday.
Enjoyed it.